Crimp. How constraints limit growth potential.
Economics and business studies often examine how constraints crimp growth in real markets. Researchers analyze how interest rates, regulations, and labor conditions crimp investment and productivity. They also track how these forces crimp long-term development across regions. In many reports, the verb crimp appears when policies or shocks reduce economic activity. For example, high interest rates can crimp consumer spending and business borrowing. When central banks raise rates, loan costs rise for households. Families then delay buying homes, cars, and durable goods. As a result, this credit tightening crimps demand and slows overall growth. Another example appears in discussions of supply chain disruptions that crimp output. When ports face congestion, goods cannot move smoothly between countries. Factories wait longer for key parts and raw materials. This delay crimps production schedules and reduces finished goods on shelves. Consequently, companies lose sales, and customers face higher prices. Moreover, analysts note how complex regulations can crimp small business expansion. Lengthy licensing rules and heavy paperwork crimp the speed of opening new firms. These barriers discourage entrepreneurs from entering competitive markets. Thus, fewer startups appear each year, and innovation can be crimped. In summary, economists and business scholars use crimp to describe how financial, logistical, and regulatory constraints limit growth potential across many sectors.
So, crimp means to physically restrict, hinder, or limit the movement, freedom, or function of something. This definition helps explain how the term applies to economic and business constraints. Synonyms include restrict, hinder, and hamper.